Two people walk into the same bank on the same day. One has $500 in their checking account. The other has $500,000. They both need help. They both walk up to the same counter. They both talk to the same bank. But what happens next is completely different. And once you understand exactly how different it is, you will never look at your bank the same way again. My name is Nick, and I spend way too much time thinking about money, banks, and the systems that most people never question. If you've ever wondered why banks seem to nickel and dime you for everything, while somehow the rich always seem to get special treatment, hit that subscribe button because this video is going to explain exactly why that happens. And I promise, by the end of this, you're going to be angry. But more importantly, you're going to know what to do about it. Here's something that most people don't realize. There are essentially two completely different banking systems operating inside the same building. One is for regular people. One is for wealthy people. And the rules, the fees, the treatment, the opportunities, they are completely different depending on which side you're on. Let's start with the regular people side, because if you've ever had a checking account with less than a few $1,000s, you know exactly what this feels like. Minimum balance fees. If your account drops below $1,500, some banks charge you $12 to $15 every single month just for the privilege of keeping your money there. Think about that. You're paying the bank to hold your money. Money that they are using to make themselves rich. Overdraft fees. The average overdraft fee in America is $35. $35. Because your account went negative by maybe $10. And here's the really cruel part. Banks have been caught deliberately reordering transactions to maximize the number of overdraft fees they can charge you. Not by accident, by design. ATM fees. Use the wrong ATM and you're paying $3 to $5 just to access your own money. Your own money that you already have. Wire transfer fees, monthly maintenance fees, paper statement fees, inactivity fees. The average American pays over $300 per year in banking fees alone. That's $300 that should be in your pocket, going directly into the bank's profit margin. But here's where it gets really interesting. Walk into that same bank with $500,000, and suddenly, every single one of those fees disappears. When you have significant wealth, banks don't treat you like a customer. They treat you like a partner. Let me walk you through exactly what changes. First, the fees vanish completely. No minimum balance requirements, no monthly maintenance fees, no overdraft charges, no ATM fees anywhere in the world. The fees that drain regular customers don't apply to wealthy ones. Why? Because the bank makes so much money from wealthy clients in other ways. They don't need to nickel and dime them. Second, you get a personal banker, not a teller, not a call center. A dedicated human being whose entire job is to manage your financial life. They know your name. They know your goals. They call you. They proactively find opportunities for you. Regular customers wait 45 minutes on hold. Wealthy customers have a direct line. Third, you get access to better interest rates. This one will make your blood boil. When a wealthy client needs a loan, they get lower interest rates than regular customers. When they want to park their cash, they get higher savings rates. The person who needs the best rates the least gets them. The person who needs them the most pays the most. This is not a coincidence. This is the system working exactly as designed. Fourth, exclusive investment opportunities, private equity deals, pre-IPO investments, hedge funds with minimum investments of $1 million or more. These opportunities, which can generate returns that completely dwarf anything available to regular investors, are simply not accessible unless you already have significant wealth. The rich get richer not just because they have more money, but because they have access to better opportunities to grow that money. Fifth, priority everything. Priority service, priority processing, priority approval on loans and credit applications. When a wealthy client applies for a mortgage, it gets fast-tracked. When a regular customer applies, they wait weeks and get asked for more documents. Now let's talk about one of the most predatory things banks do and why it specifically targets people with the least money: overdraft protection. Banks market this as a service, a safety net, protection for when things go wrong. But here's what overdraft protection actually is. It's a short-term loan at an interest rate that would make a loan shark blush. Let's do the math. You overdraft your account by $20. The bank covers it and charges you a $35 fee. You pay back the $20 overdraft the next day when your paycheck hits. You borrowed $20 for one day and paid $35 for it. That is an annualized interest rate of over 6,000%. 6,000%. Meanwhile, that same bank is offering wealthy clients personal lines of credit at 4 to 6% interest. The person who can least afford to borrow money pays the highest price to borrow it. The person who doesn't need to borrow money gets offered it at almost no cost, and it gets worse. Research has shown that overdraft fees disproportionately hit low-income customers. The people living paycheck to paycheck, the ones who can least afford a $35 surprise charge, are the ones funding the bank's overdraft fee revenue. In 2022, American banks collected over $7 billion in overdraft fees alone. $7 billion. Taken almost entirely from the customers who could afford it the least. Here's something that sounds almost too simple, but most people never actually sit down and calculate. Your bank savings account is almost certainly losing you money. Right now, the average big bank savings account pays somewhere around 0.01 to 0.5% annual interest. Meanwhile, inflation runs at 3 to 4% per year on average. So your money is sitting in the bank, feeling safe, while silently losing purchasing power every single day. You put in $10,000. A year later, you still have $10,000, maybe $10,050 if you're lucky. But that $10,050 buys less than the original $10,000 did because everything costs more. The bank didn't steal your money, but it didn't protect it either. Now here's what wealthy clients do differently. They don't keep significant cash in regular savings accounts. They use high-yield savings accounts, money market accounts, treasury bills, short-term bonds, all things that pay 4 to 5% or more in the current environment. The difference sounds small, but on $100,000, the difference between 0.1% and 5% is $4,900 per year. That's almost $5,000 per year, just from knowing where to put your cash. And the banks know this. They just don't tell you.
Okay, so the system is rigged. Banks treat people differently based on wealth. The fees hit the poor hardest. Your savings are losing value. What do you actually do? Here's the good news. You don't have to be wealthy to start fighting back against this system. You just have to be informed. Step 1. Switch to a high-yield savings account immediately. Online banks like Marcus, Ally, or SoFi currently offer savings rates of 4 to 5%. Your big bank offers 0.01%. There is no reason, zero, to keep your emergency fund in a traditional savings account. Move it this week. Step 2. Find a no-fee checking account. Credit unions and online banks almost universally offer free checking with no minimum balance requirements. If your current bank is charging you monthly fees, you are literally paying for a worse product than you can get for free elsewhere. Step 3. Opt out of overdraft protection. I know this sounds scary, but if you opt out, a declined transaction is just a declined transaction, not a $35 fee. Build a small buffer in your checking account instead, even $200 to $300, and overdrafts become almost impossible. Step 4. Understand that banks are not your financial advisor. The banker at your local branch is a salesperson. Their job is to sell you products, savings accounts, credit cards, loans, insurance that generate revenue for the bank. They are not legally required to act in your best interest. A fiduciary financial advisor is. Know the difference. Step 5. Start building the balance that unlocks better treatment. This sounds circular, but it's true. The path to being treated better by banks is to need banks less. Build your emergency fund. Pay off high-interest debt. Start investing. The more financial security you build, the less leverage banks have over you.
Here's the uncomfortable truth about banks. They are not evil. They are not villains twirling mustaches in boardrooms. They are businesses, doing exactly what businesses do, maximizing profit. And the most profitable thing a bank can do is charge fees to people who have no alternatives, while offering premium services to people who generate more revenue. The system isn't personal, but the impact is. Every overdraft fee, every monthly maintenance charge, every year of 0.01% interest on your savings. That's real money. Your money. That could have been building your future instead of someone else's profit. The difference between the person who gets trapped by this system and the person who escapes it isn't luck. It's not income. It's not even how much money they have right now. It's knowledge. And now you have it. So the question is, what are you going to do with it? Subscribe for more videos that tell you what the financial system never will.